this is my number one question. What is a reasonable amount to spend on a renovation? So there's a very distinct method with this. So my head thinks in proportions of the purchase price. So obviously you've got a stonking purchase price anyway. Would be easily looking to spend sort of 20, maybe 25%, and that would be completely acceptable on top as a renovation spend. The key to it being that you need to see a certain multiple of value uplift on top to make that worthwhile, because you can spend whatever you like, but if you have no framework from which to go, the value starts here, you need to know the end value or have an idea of how to calculate that end value.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today we've got our property coach, Ilse Wolfe, on the podcast to talk about why James and Mike bought 12 houses in Upper Hutt.
We're back in your life, and today we're sharing the journey that Mike and I have gone on with Ilse. Ilse, welcome back to the podcast.
Thank you. All very, even more exciting to be talking about your project and what you're up to.
Yeah, our relationship has gone to the next level since the last episode we've done together, hasn't it?
Sure has.
Okay, so before we jump into it with a little bit of background, Mike, tell us, what have we done?
So James and I, with Ilse's help, have bought 12 units in Upper Hutt for $2.4 million, and we plan on renovating them, revaluing them, renting them out, and then trying to go again. So quite a big project to tackle right at the start, but hey, we've got the expert with us. I'm sure we can do it.
Yeah, and you go big or you go home, right?
Oh yeah. Have you done that?
Yeah. So just as a little bit of background, so when we have clients who are thinking about investment property and want a strategy where they can be, I guess, a little bit more hands-on, be able to add value, we will send them over to Ilse to go, there might be an opportunity to work together. Now, Ilse, I kind of think back to some of the conversations you and I had at the start. What were your takeaways from those conversations?
Is that when you attacked me about...
It's not that we didn't believe you about the numbers. We just wanted to know, do you get these numbers?
Yeah. So thanks for having me back. And I guess specifically we're talking about my boardroom course, which is multi-units, which is far more involved, a lot more variables, far more complex than your average BRRRR, right? It's quite common to buy, renovate, rent, refinance, repeat a standalone house. Plenty of sales out there, plenty of evidence to show roughly what those proportions are, what to spend, how much to renovate, that kind of thing. When it comes to multi-units, it's a lot more involved, as you're learning, right? So there's some pretty aggressive goals, and I really do set the bar super high for the boardroom service. So first and foremost, it's double-digit gross returns, so 10% plus returns on total debt. So that assumes full purchase price and renovation spend combined, and we want the post-renovation rent to perform at least 10%. And I remember the day I got this call from James, sort of dancing around with his words, going, so those deals, when your clients actually do those multi-unit deals, do they achieve 10%? I was like trying not to be insulted or like offended. Like,
don't worry, Ilse, you're not the first person that have been offended by me, and you won't be the last. As a financial advisor, you do learn to be quite skeptical.
Yeah.
Because, people come to you with varying levels of financial literacy, and it's your job, my job to really make sure that I've got a lot of confidence in whatever I'm doing with clients. So I didn't know how to put it politely, but when it's just like, look, we buy a place under value, we renovate it, we get the rents up, we have some more cash, how good? And I'm just thinking to myself, what's the catch?
Right. Yeah. And fair enough, right? Because as well as the gross return, it's, a client coming to me for a multi-unit value add, they're looking for, 400,000, 500,000 net equity uplift after all that effort. And I can appreciate from the outside, those look like crazy numbers sometimes. Yeah.
It just looks, like from the start, it almost looks too good to be true. And that's the thing that James and I are always looking out for when we give advice to our customers. Like, can we 100% trust that when we send the customer this person, one, they get the outcome that they think they're going to get, and two, that the service is good enough where someone isn't going to turn around and go, you guys sent me to this person, that's it. Like, we're never speaking again, sort of thing. Yeah.
And as you can see, obviously that conversation went well because now we're drinking the Kool-Aid.
Yeah.
So So we've had quite a few clients work with you, Ilse. We've seen kind of the outcomes over a period of time. What I'm keen to, because the original conversation, I don't think I was involved in. I think it was the two of
Mm.
you,
For this deal?
scheming
Yeah.
something up,
So,
and then
Always.
and then I worked out, okay, there's probably some money to be made. I have no lending skills. I have no renovation skills, but I think I can probably make some money here. So I just kind of like weaseled my way in.
I
But
love that for the first probably 3 weeks of putting it together and doing the like DD and the leader, James has had no, like, James was like, I don't know, man. Just like, how are we going? Just tell me good. Just tell me good.
in the
Yeah.
group chat,
Yeah.
James is sitting pretty.
Yeah.
Yeah. That was, so the three of us have a group chat, and my response as these guys were going back and forwards is, I'll just sit here and look pretty,
Yeah.
because that's really all I could do, and thank God I can do it well. So tell me the deal. Where did it start? Where you
Yeah.
guys were thinking maybe let's do something? Yeah.
So, as I say, the benchmark for these sorts of deals is super high, right? So, 75% of the multi-units that are out online are not suitable for our expectations and the results that we want to create. So, as well as on market, I have a pretty strong reliance on some off-market sources as well. And in this case, it's really beneficial for a couple of obvious reasons. One of those being that you can usually buy for a good discount. What was unique about this one is that for that, I guess, wholesale seller trying to pass this deal on, is that it's 12 one-bedroom units on 12 individual titles. So that's a very, very unique property. Knowing that I have buyers with those sorts of criteria, when they can work back from what they find and find that it meets, I become kind of the first place that they go to, right? So this one came across the desk, I sent it across and going, oh, okay, this was actually sent to me for me to buy. And then had a look at it. At some point, I think your ears pricked up in the office and you heard, is that how it happened, Mike?
Yeah. So I think AJ was talking about it, and all I heard was 12 units on 12 titles. And I was like, you what?
Yeah.
Because instantly for me as a lender or as on the finance side, I go, that's resi. That's a residential deal. And what you don't usually get when you're getting 12, that's very difficult to get something that large onto residential interest rates. So what I see there is probably a 1.5% difference on the end margin.
Yes.
So that's what made my ears prick up. Yeah.
That's right. If you're not working with the right broker or lender and you end up on commercial rates, it breaks the deal. Like it literally can break the cash flow. Yield is one thing, but the cash flow post-tax cash, is it putting cash in your hand or is it taking it out?
Yeah.
And when you have 12 units taking cash out of your pocket, that's not
That's
a place no one wants to be.
Yeah. And so that's what I heard. And I hadn't heard anything else. AJ must have been talking to you on the phone and I didn't hear the location, the price, anything else. All I heard was 12 units, 12 individual titles. And I was like, what is that? Just to clarify that, because not everyone is, super in depth on the property side, is, usually when you have a block of land and it has some houses on it, like a multi-unit, it will be on one title, which means that in the government's eyes or the council's eyes, there's one block of land with 12 houses, and that is the description on the land register of that property. Now, for a bank, they look at that and go, that's not a standard residential piece of land with a standard residential house on it. That's commercial. It's riskier. It's more expensive. This was 12 individual houses on 12 individual titles being sold as one big block. Now, when a bank looks at that, they go, well, I can sell each of those individually. So that's less risky. That's more of a residential style deal. And it's not a pure residential deal. A bank will still try and get that on commercial rates because they look at it and go, nah, it's still not normal.
Yeah.
But you have a much better case to argue with that kind of title setup. Yeah.
Yeah. And what's really special about this one is that in spite of having 12 unique titles, effectively they could be sold off to 12 banks if we had them, right?
Yeah.
So in this case, you get the benefit of that because you have 12 parcels of land, which in New Zealand, that's the megabucks, right? And normally when you buy them all, like 12 on one title, the idea is that you've bought 12 houses, but you haven't bought 12 bits of land. So that usually comes with better efficiency for cash flow and a bit of a discount because it's one slab of dirt, right? You've got the best of both. You've actually got 12 bits of land, 12 rentals. So full flexibility, ease of exit, which the bank's looking at. But because of the price, you've got the best efficiency, like literally it nails all points.
Yeah.
Yeah. Ilse, I mean, apart from the individual titles, you mentioned before for the boardroom deals, 75% of the deals you see don't meet the criteria for it to be a boardroom deal. What did you like about this deal?
That was a really unique factor, having the 12 on 12. And also the structure of them. So physically, it's also unique. So rather than have, they're commonly called sausage blocks, where you have 4 or 6 or 8. True story.
Sorry. I've never heard that before.
Oh, God. In this case, we have 6 A-frames, standalone buildings. So it already looks unique. On paper, it's unique. You get 12 parcels of land. And what is really great about this property is it's very spacious. It's quite uniquely set up. So you've got this, almost half an acre of land, very grassy, 6 A-frames split into 2 times 1 bedroom duplexes, right? Great materials or aluminium joinery, which is a bonus when you have 12 sets of joinery to maintain. And this really lovely flat ground with grass and privacy and space. But even though it's not part of the current scope, you can easily privatize each of those 12 areas even more in future. So there are several wins of value add that I see, but also it's really well set up with car parking, which often isn't the case. You have 2 separate entrances to the section, each with multiple car parks, really wide turn bays. It's just a total ease of life. So when a valuer comes to look at a multi-unit property, they are always considering the sustainable income. So the more attractive and the ease of use for the people who move in, that helps sustainable income, and that has a positive impact on value too.
Safe to say as well, the units need a little bit of love.
They definitely need a little bit of love. So that's what we want, right? The uglier the better. We want that value add, which is you coming to love the process as well.
Yeah.
So James, before we continue, I have got a special announcement.
Have you started sticking to your budget?
Absolutely not.
You finally made it as an after-hours DJ.
I wish. Mate, the thing is, we have got a brand new podcast partner, Partners Life.
You mean the award-winning insurance provider with over 300,000 Kiwis insured?
Yep, they're also a New Zealand operated company, and they are passionate about increasing financial literacy amongst Kiwis.
Sounds like a great match. Where can I learn more about them?
Check out their website in our show notes below.
Really thought DJ Magic Mike was going to be a global sensation for a second.
So when it comes to the method, this is where things get more complex with the multi-units, because if you haven't renovated before and all of a sudden you need to renovate 12, you're thinking, well, this is my number one question. What is a reasonable amount to spend on a renovation? So there's a very distinct method with this. So my head thinks in proportions of the purchase price. So obviously you've got a stonking purchase price anyway. But, would be easily looking to spend sort of 20, maybe 25%, and that would be completely acceptable on top as a renovation spend. The key to it being that you need to see a certain multiple of value uplift on top to make that worthwhile, because you can spend whatever you like, but if you have no framework from which to go, the value starts here, you need to know the end value or have an idea of how to calculate that in value. And then the fun part is that game of, I see it as a game. There's a margin between, 2.4 is the purchase price, and say if it was going to revalue it 3 million, okay, well that's a fairly light value add relative to the purchase price, in my opinion. So then the game becomes, if I know it goes from 2.4, this is just theoretically, from 2.4 to 3 million, there's a margin of 600,000. And that is made up of the difference of equity, net equity, and how much you spend on the renovation, right? Those are the 2 components. So the lower you can keep the renovation spend, the more you get to bank as net equity. That's the goal.
Yeah. Mike, I think it's important that we talk about that we got very, very close to walking away from this deal. Do you want to talk us through that?
Yeah. So when we were looking at the rough numbers originally and looking at what would the plan, what would the uplift be, it's I guess one of a really strong thing in finance and decision making is anchoring buyers, and James and I are no exception to that. So we had an idea in our head that it was going to come in totally revalued at a certain price. And then when we got the initial valuation, it came in slightly lower. And I knew in the background that we could contemporaneously settle it. So that is when you buy and sell on the same day. So what would happen is I knew we could sell it for $150,000 more by effectively doing nothing, right? So in one day, James and I were going to make 150 grand by buying the property and then 10 minutes later selling it again, right? A contemporaneous settlement.
And I didn't really like the contemporaneous sale because
it's because you couldn't say the word.
It's because I couldn't say the word. Although I just had a break about halfway through, had a little drink, and then kept going.
Yeah.
I didn't like it because the person behind us, so we would have to go unconditional, and the person behind us would be conditional on the property. I didn't like that risk. But when we were initially talking about the numbers, so we were looking at buying it for 2.4. I think it was the CV was 4.2, and we thought the valuation would come in at that point, and we're like, my goodness, Mike, we are just going to have to work out how to spend all this
shut
money.
up White House and just go retire.
Yeah. And then so you go, well, I'm going from 2.4, I'm going to spend about 250 grand, so I'm going to be maybe at 2.65 and get something for 4.2. You know, I'm making pretty much like $1.5 million of cash, and you're going, this is amazing. And anything under that outcome, you then go, no, this isn't as good. So we got the valuation done on the property, and I think the valuation on the property came in post renovations at like, I think it was 2.8 or something like that, and we were just like, well, this is completely pointless. And one thing
we had a meeting. I remember it was the end of the day, and we're sitting there, and I was like, because the words came out of my mouth, James, you know, some people work all year for 150 grand, for less than 150 grand. We could just contempt this thing tomorrow, walk away with 150K, and we're the smartest guys in the room, right? And we're like, we'll sleep on it overnight, and we'll come back in the morning and see how we feel.
Yeah. Now, one thing we realized with the valuation was done pretty much on the property right now. It wasn't done post the renovations being done. And I think, have them done based off the individual titles or no?
It was on the individual titles, but it was basically just a slight rent uplift.
Yeah. It wasn't based off the renovations. So once because you get all fired up, you don't really read the whole document. Mike and I barely read anything. And so anyway, we were like, let's go back to, we called the valuer and we were like, these individual units, if they got renovated to the standard, where would they be? So we've got 12 units. He goes, probably like between 280 and 300 grand a pop. And you go, hold up, that's about 3.3 to 3.6. Now we're talking about 2.6 all in and getting to maybe 3.6, 600 grand to like 900,000 odd dollars. That sounds a lot better. We got very, very close to, I think it was the day before going unconditional, and we were asking for more time, and we were probably going to bail on the property. And if you think about people like myself and Mike going, can't differentiate what is actually a great deal and having the right information as well, Ilse, to make the deal?
I think that's right. Having a reference point, especially because you're right, our initial hype was, oh my gosh, CV, I think it's 4.8.
Yeah, it's
and
huge.
It was twice. The price we were offered is half the CV, and we thought, how is this not a deal? Like, it's a deal all day, every day. But then mentally, that's where we set the bar for what we expected, right? So then that becomes the reference point. We dropped our, killed our expectations for a second. So all of a sudden we're going, it's not what we thought it was. And I think because you don't look at the multi-units in the same way that I do all day, every day, and see the trends of the results and what's possible. I remember having several conversations with you, James. I could hear you were moving away for all the different points. I'm like, I can't tell you to buy this deal.
Yeah.
But the day before, I thought, I need to point out a few key things and explain that, the net uplift, if you could get 400,000 as a net, that is great, and depending on the way that the rest of the renovation and the tenant types, etc., eventuate, there's a massive upside even from there that is definitely seven figures in the pipeline for this property, right? So knowing that, needing to reset and go, hey, where else or how else can you achieve that in like a 10-week time frame? So I remember having those conversations and needing to point out certain strengths and then and kind of setting you free and hoping and knowing
Yeah.
you'd make the right decision.
Oh, I tell you what, it was 50-50 at
Well,
best for a point.
We both walked in the next morning into the office and we were like, what do we do? Like, we've got to do this.
Yeah.
You know, like, I think we're both,
It is a journey because
Yeah.
you have all of the yeses, nos, up, down through that due diligence process.
Yeah.
And I remember you'd had the conversation with the valuer, and at some point I thought I need to step in and just give a ton of information here to help the valuer get confidence around what we're doing. Because even that evolved, right? We were talking initially about maybe 20,000 per unit based on an initial idea. We had some appraisals. We knew that if we upgraded the flooring, the paint alone, we could get X amount of rent. But then actually by doing a more thorough job, because when you started to see the value uplift rather than just the cash flow, that got exciting for you. So then we ended up, increasing the scope of the works. When you are in a new location with a valuer who does not know you and does not know what the quality of your result is going to be, you have to supply a lot more information, which is why that Excel, we had, kind of like a grid and a checklist of each unit, what would be involved, and the level of finish. That's when a valuer gets confidence because they're very conservative by nature.
Especially in the current market as well,
Yes.
right?
Yeah.
Because that's another huge part.
Yeah.
The decision, like the framework for the decision for me, I got to on that day, which I was talking to Mike about, was, are we going to look back and regret this? Are we going to look back and go, we should have done this? And thank God that we ended up pulling the trigger and getting on with this, because we got very, very close to doing it. So we did pull the trigger. So we're going to pause here, and you're going to have to subscribe, review, and like to see part 2, where we talk about the plans for the property. We talk about how Mike gets the financing. We talk about the things that have gone well. And of course, with these kind of projects, things that haven't gone well and things that Mike and I have been surprised by. Now, just before we finish this episode, we must point out, Mike and I are both financial advisors. We are not advocating that everybody goes and buys 12 units, right? And if you are interested in a strategy like this, go and talk to Ilse. We're going to leave it there. Catch us for the next episode where we break it all down.
Cheers.
Thanks.